Hello everyone, this is Shilpa Shri MS from Government First Grade College, Bairapur. In today's session, which is session 4, we are going to see sources of risk. What are the different sources of risk, and at the end of the session, we are going to see MCQs. In the previous sessions, we have seen what is risk, what is investment risk, and what are the different types of risk, and the difference between those risks, which is systematic and unsystematic risk. In today's session, we are going to see what are the different sources of risk, and by the end of the session, you should be able to understand what is interest rate risk, which we are going to exclusively discuss in this session. There are basically three different sources of risk. One is interest rate risk, market risk, and business risk. In this session, which is session 4, we are going to exclusively see what do you mean by interest rate risk. Interest rate risk is the variability in the securities written resulting from changes in the level of interest rates. Other things being equal, security prices move inversely to interest rates. This risk affects bondholders more directly than equity investors. What is interest rate risk basically? Interest rate risk is nothing but it is a risk that whenever a person, an investor, invests his capital in the debt securities like bonds and debentures, he is getting return, which is interest. Shareholders, as we all know, they get dividend for the investment in the shares, whereas debt and debenture holders, they get interest in return for the investment they have made in bonds and debentures. So likewise, what basically happened, let's take an example. If Mr. A has invested rupees 10,000 in the bonds, or let's assume he has invested 10% debentures in XYZ company. So when he purchased 10,000 worth of debentures and the rate of maturity, that is the time of maturity, let's assume it is 20 years. So he can hold the debentures until 20 years, or rather he can sell the debentures in the open market or in the secondary market. But what basically happens whenever there is a debt instrument, bond or a debenture of a company which has a higher rate, or let's assume that XYZ company has issued bonds or debentures at more interest rate, let's assume for 12% interest rate. Now when the investor Mr. A wants to sell his debentures in the open market, the price of the debentures will definitely come down, because the people who want to invest in the debentures would go for new debenture which is possessing 12% interest rather than buying 10% interest. This example is sufficient for you to understand what is basically interest rate risk. Going to the next slide, I am going to slowly read out what is it once again. Interest rate risk is the potential for investment losses that results from a change in interest rates. If interest rates rise, for instance, the value of the bond or other fixed investment will decline. Yes, whenever the interest rates in the open market increases, the old debentures possessing the less interest rate, the price will decline. That is what they are just trying to tell. So let's understand in detail what it is, the key understandings of interest rate risk. Firstly, and as interest rates rise, bond prices fall and vice versa. This means that the market price of existing bonds drops to offset the more attractive rates of new bond issues. Yes, whenever the interest rate rises in the market, the price of the debentures will decline. Second point, interest rate risk is measured by a fixed income security duration, with longer term bonds having a greater price sensitivity to rate changes. Interest rate risk is measured by a fixed income security duration. Yes, let's assume like a debenture is having a 5 years maturity, 10 years maturity, 15 years maturity, 20 years maturity. So longer bonds have a greater price sensitivity, because in this gap, if at all a new debenture is issued with a higher rate of interest, then automatically the prices for such bonds or debentures will decline in the secondary market. Thirdly, interest rate risk can be reduced through diversification of bond maturities or hedging using interest rate derivatives. That means you can hedge. Hedge means once Once you have bought, you can rather go for another bond or debenture having a different interest rate, so that the difference in the interest rates is going to set off. So hedging is altogether a different topic which we are going to discuss in some other session. So we are going to see the multiple choice questions. Interest rate risk arises out of change in the interest rate of a new bond, change in the interest rate of existing bond, none of the above, all of the above. We all know if interest rate risk arises, that whenever a new bond is issued and there is a change in the interest rate. So answer is option A, change in the interest rate of a new bond. Question number 2. Interest rate risk affects bondholders, shareholders, none of the above, all of the above. Yes, we very well know the debt holders, that is the bond holders, are much affected, not the shareholders. So the answer is option A, bond holders. Question number 3. If the interest rate increases in the market, what will happen to the bond prices? The bond prices increase, the bond prices decline, none of the above, all of the above. Interest rate increases in the market, the bond prices will decline. The answer is option B. If the market price of an existing bond drops, then the interest rates has risen in the market, the interest rate has declined in the market, none of the above, all of the above. This is a vice versa situation. If the market price of the existing bonds, the market price of the existing bonds drop, that means the interest rate has risen in the market. So this is the sources from where I have taken the information. Thank you and see you in the next session.